Hey, everybody, welcome to the morning market briefing. It's Monday, January 26th, 2026. Hope you are doing well out there, that you survived the big ice storm. Roads were quite dry this morning here locally, so all is well that ends well. The boys are here. We are in action.
Ben's camera's pointed at the wall.
Oh, man, we lost him. We get him back?
No, I'm going to have to stand up and move it.
Yeah,
If we want to
so
see Ben today.
I guess we do. Let's jump in here, though. Shutdown risk seems to be on the rise. If you're a longtime listener to our podcast, you know that there's no topic I have more disdain for than talking about shutdowns. We just survived one. Everybody came out on the other end mostly intact. But Chuck Schumer now saying he's going to block the continuing resolution unless Republicans reduce funding to the Department of Homeland Security and ICE. This comes after tensions continued to escalate in Minneapolis over the weekend with another incident involving ICE officers and protesters. Ben, as you think about the economic impact, what's at risk here?
Yeah, I mean, I think it's kind of the magnitude and the likelihood of it happening. I think the magnitude, especially having it happened once already, is probably not going to be as much. But I think most agencies will, or a number of agencies that had been extended will have been extended through the full fiscal year of the government. So it wouldn't be as many departments of the federal government that are shutting down, but it still would be significant. And I think it would be a blow to the president's agenda, and it would look really bad coming ahead of the State of the Union address. So I don't think it'll actually happen. I think the Democrats have a little bit of leverage here, and I think that they can make a deal on it. So we'll see what happens with it, but I would actually take the other side. I know some of the prediction markets have a 75 to 80% chance of a government shutdown, but I would say, not so fast. I think that Schumer knows he has a good hand, and he's playing it. And I think that even if you look at the Republicans are more disjointed than they've been over the last 2 years, or last year, under the new Trump administration.
I want to jump to some economic data, and then we'll move around. But durable goods orders, this is a delayed report. This is for November. We were looking for 3.8. Came in at 5.3. On excluding transports, expectation was 0.3. We came in at 0.5. I mean, big numbers there.
This is going to feed directly into the GDP now.
Yeah, I'm very interested to see
the GDP live
updates later.
Yeah, I think it'll probably usually around 10 or 11 a.m. It seems like it does. But wow, that's a really impressive number, and what it means is that you're going to see higher GDP even than this 5.4%, because what filters through is kind of this trend line of growth and into the GDP now equation. And so if you put something in higher, even if you put what the estimate was, it probably would have a beneficial result onto the GDP. But now you're going even higher than that. And I think this is really going to be, this might take us to like 5.7%, 5.8%. I will have to see when it gets updated.
I mean, hottest country.
I mean, there's a lot of nuance there, but like the only reason that number is so high, I mean, this is, well, maybe perhaps a smaller secondary reason, is because the trade deficit was so small for the first time in 16 years. And there's really only one way to interpret that, in my opinion.
Yeah, and we saw GDP now spike when we got that trade deficit number. This may not be as pronounced of a spike, but it, again, to Ben's point, continues to bake into the cake and tick upwards. We are seeing some U.S. dollar weakness, though, Ben. What's your read-through?
Yeah, I think there's some concern that the U.S. is really the U.S. for whatever reason. There's a thinking that the U.S. Budget deficit is expanding, and that the surplus is eroding, and that we're entering a period of more significant fiscal stimulus, which is going to result in potentially higher bond yields, but then also higher precious metals and weaker currencies relative to others. The other thing that Secretary Bessent's doing, and he's talked about this a number of times, is kind of leveraging the U.S. government balance sheet. We saw what he did with the Argentinian swaps, buying Argentinian currency, which essentially means you're selling U.S. dollars. And there was a lot of thinking that because of the rise in Japanese interest rates, that Bessent was on it. And he was saying, you know what, we're going to buy the dip in the Japanese currency, stabilize that currency, and we'll make money. But more importantly, we're going to prevent the flush out of yen and yen bonds, because we know that if yen bonds go up in yield, then U.S. bonds look relatively less attractive. I am less concerned about that than most finance people. I think a lot of finance people say this is ground zero for what will be the government fiscal blowups is in Japan. But at the end of the day, at 0.75% on your 10-year rate, or 0.75% on your headline rate, I just don't think the Japanese are there yet. So I'm not as concerned about it, but there was a thinking that Bessent, again, is using the balance sheet, selling U.S. dollars, and buying yen to stabilize that currency. I think everyone's kind of denied that, but that was the thinking.
There's also a lot of, if you're on Twitter much, there's a lot of, Japanese carry trade talk, which is the idea that people are borrowing money in yen and buying U.S. stocks, and that if the Japanese bonds blow out, then people are going to have to sell their stocks so they don't get killed. But I think that, one, bond prices, I mean, they move in a sawtooth fashion, and you can see blowouts like we saw the other day, but your losses are very small, and it gives you plenty of time to make those trades. So it's not like people are just going to suddenly waterfall out. And if they do, Japan is already dead. So I think that it wouldn't be, I don't think that that's necessarily as dynamic as people think it is. And if you look at the net effect on the 30-year, week over week, last week we spiked to a 495. We're sitting at a 481 right now. So we're exactly back where we were. A lot of people are saying really smart money was buying some long treasuries last week while they were on discount, and now we've made a little bit of money, and we're still locked in at a higher rate than can be touched right now. But, those are just the very smart people. I can't think of any off the top of my head.
Yeah, nobody in particular.
Andrew, just really quickly going back to the durable goods orders, I think what's going to be really interesting, and you made a point on this on another podcast you were on at the end of last week, but the interesting point that you made was you have Atlanta Fed GDP now, which uses live incoming data, having a 5.4% estimate for Q4 GDP, which again, as I mentioned, will probably go up after this data this morning. And yet Wall Street economist consensus is still right around 1% or maybe a little bit above. And so I think we got to see a lot more. That gator mouth needs to close, and I think it's going to close one way. I think that economists coming back will start to ratchet up their expectation, but typically the Wall Street economists tend to operate more on a lag than the real-time data we get with GDP now.
Yep, takes them a minute. This is not on the agenda, but Tom, I wanted to talk a little bit about BlackRock. With a private credit fund taking a write-down of 19% for the fourth quarter, they're waiving 1/3 of the management fee. Interestingly, the actual private credit fund itself, which is BlackRock TCP Capital Corp, only down 14% pre-market. So valuation's gotten richer.
Yeah, I mean, they did an all-time move, which is drop a piece of very bad news at 5:30 on a Friday afternoon. But it's wild because for the last 3 years, you go to any conference, Ben and I have spoken at a number of conferences, we sat in on them. It's the golden age of private credit. Everybody wants to get on private credit. How do we democratize private credit for the retail investor? How can we get people in
these
things?
Get them in the 401ks.
Yeah, get them in the 401ks. How do I give somebody the opportunity to have an insanely illiquid asset that's backed by lots of leverage and is paying you yields that aren't really that much greater than you would get on normal bonds, but they seem fancy, and that way I can differentiate myself as an advisor because I don't know how to buy bonds, is really the pitch. And that's starting to blow up in people's faces because as more and more people funneled into these illiquid assets, they got expensive for what they were. When rates were very low and credit was really differentiated and you could get 5, 6, 7% on something that was private and hold it through and kind of be agnostic to rates rising and get a really good yield and then get cashed out right around now, the rotation should not be into more private credit. What it should be going into is more public credit. And this is the golden age of public credit, and people have been getting that wrong incessantly for years. But now we've seen these things blow up. We've seen First Brands blow up. We've seen the HVAC and interior drywall roll up out of Texas. I think it was called Renovo, blow up. And so suddenly, we have these.
Even Saks had a bunch of private debt.
Yeah, and so here we are. We've rolled you up in this big private debt fund, but sure, you got 9% for 2 years. Well, you just took a 19% write down, which the math is pretty easy to figure out. You made 1% over the last 2 years because you just took a massive hickey on the the credit instruments inside that fund. And I don't think it's going to get much better in the short term because we've just seen so many people bloat up in these private credit deals. And if risk reward is a seesaw, you've seen the reward go down and the risk go up, and then suddenly we're seeing that come to fruition where you've taken too much risk for what you're getting. So I expect this to continue. We talked about the Blue Owl Fund, having the same thing where they had a huge chunk of people trying to get out before the end of the quarter, and they've got gates on these things. You can only get so much out. So if you took a 19% hickey, and they're very nicely taking a little bit off the fee, which is upwards of 2%. So you're saving 40 basis points on something that now has lost 20% in a weekend.
What a trade-off.
Yeah, what a great deal for you. I think it's important to note that sometimes, blocking and tackling is the most important thing, and running triple reverse, running back passes usually doesn't work out. It can if you're in a real crunch and you need to have a big play, sure, but you shouldn't be saying, "Oh, this is the safe part of my portfolio. This is the safe part of my offensive playbook." It's actually the opposite.
Want to talk busy week here, and Tom, you're going to be out some, but on the economy, Tom, a question for you, and then Ben, I'm going to come to you on earnings reports. You're going to be out on Wednesday. What could be said coming out of the Fed meeting that you think that's both realistic and would have a meaningful impact on markets?
I don't even know that there is anything. I think we're so locked into nothing's going to happen until we get a new Fed chair. There's nothing I can really think of. Maybe a little bit in terms of they've started buying some mortgages, or there's been some movement there. They're trying to jumpstart the housing market. There's just nothing in there that I think they can do. They're going to say, hey, employment continues to erode. Growth is very strong, maybe stronger than we thought. Inflation continues to be coming down at a reasonable pace. There's just not much in there that I think that Jay Powell could say. I don't know, Ben, if you have any thoughts on that. I don't know what
just
it could
a
be.
nothing burger.
I think the Q&A is going to try to paint him into a corner. I think he's going to be asked about Lisa Cook. I think he's going to be asked about being served, but I think that
I just don't think any of that moves markets.
I agree.
Bond traders are smarter than that. A lot of people are saying.
So Ben, I'm going to put you on the spot because we have a massive amount of earnings coming through. Really hitting the ground running hard tomorrow with United Health and others. But if you had to pick one company that you are looking at, not so much retroactively, but you're looking at their earnings report specifically to give you a feel on, okay, what's market reaction going to be for the next couple weeks? What company is in a position to actually swing things either positively or negatively?
Microsoft needs to put in a bottom. It's been going down and down for some period of time. It's one of the largest companies on the planet. And they need to, show that they're not getting eaten up by AI. There's a negative thinking about Microsoft that, one, they bet on the wrong horse in AI by betting on OpenAI. Number two, that they're spending too much money for too little return. And then number three, they're getting disintermediated by it. And so they need to come in and stem the tide that's going against them. What's also interesting about Microsoft, in contrast to some of these other companies, I think the vast majority of companies, I think we're looking for a lot of news this week. I think it's probably going to be pretty mundane. I think Q4 was good enough, and I think that they're going to not try to shoot for the fences for providing guidance for the full year. So I think that all spells hey, it was a solid quarter, but maybe disappointing guidance for most of these companies, which is something that we've seen from other companies in the last couple of weeks. But Microsoft's quarter ends at the end of June. Fiscal year ends at the end of June. So they'll be able to update guidance. And I think that has a little bit more signal and a little bit more information in that versus just coming out and trying to provide guidance. New. Yeah, and basically what a lot of these other companies are going to do is they're going to provide guidance that's good enough that it's not going to severely disappoint the street, but also not going to box themselves into a corner and give themselves an impossible bar.
I like it. Ben, you want to talk about your Seahawks to close us out?
Man, I'm really excited about it. It's a really fun team. I don't know how I feel about that unsportsmanlike conduct penalty. It was 4th and 12. Reek Woolen, our corner, had just broken up a pass from Puka and then started to jaw at the bench and got a 15-yard unsportsmanlike conduct penalty, and then the Rams marched down. I think on the next play, I think they got a touchdown. But it was a good game. It was a fun game, and I'm really excited for the Super Bowl and exacting the revenge on the Patriots. And we'll do it on behalf of Atlanta as well.
There you go.
So,
yeah, I'll tell you which was not necessarily a fun game to watch was the Pats and Broncos.
Yeah.
Other than the enjoyment of, as I alluded to you guys pre-call, like I was mostly just listening to the game, but I saw glimpses, and then all of a sudden the field was just covered in snow.
You might as well have just listened.
And it was like, this makes a lot more sense. I mean, the Broncos had one first down in the second half.
I think there was one play where Drake May basically just threw it away, and the announcer said no. I think Tony Romo was like, no, he was like, unless he was wide open, he was always going to throw that ball away. And it was like a 3rd and 8 with 4 minutes left. They're only up by 3. And it's like, no, we'll just punt it back to them at midfield.
Yeah, we're good.
And they're not going to do anything.
I mean, there was one play where I think it was Ramondre Stevenson fell down, and then Drake May fell down, and that was the whole play. Yeah. So he went to hand it off to him. He was on the ground, so then Drake May just fell down. And that was the football game in a nutshell.
Yeah, not necessarily one that's going to go down in history, although it was, I guess, on paper, a close game.
I will say, love a snow game. There's been a lot of snow games this playoffs. Yeah. We need to do away with the dome.
I like the more pure snow game, though, where it's like we know it's a snow game. I mean, I feel like that was a lot of it. I mean, it was the entire pace of play, style of play, and ability to make a play just evaporated when that snow started accumulating.
Yeah.
Whereas I feel like usually when you see, a game in Buffalo or wherever, and it's like, oh, there's 6 inches of snow on the field. The plows have been out. The bleachers are covered in snow and ice. You get some fun football there.
Yeah. It looks right.
Yeah.
Watching football in snow just feels right.
Yeah. I like it. All right. We'll wrap it up there. No call tomorrow. We are not doing a call tomorrow. We are devoid of production capabilities. Junior super producer Harrison Fish is running this call, but he is flying out of town tomorrow morning while senior super producer Jonathan Hicks is on his way back. So we just can't do a call. We don't know how to do it. We just know how to talk. So no call tomorrow. We will be back on Wednesday. In the meantime, make sure you subscribe to the channel, like it, share it, all that good stuff, and we'll talk to you soon.